Hello, everybody. So thank you all for taking some time out today for our Mid-Year Outlook webinar. My name is Melvin from Syfe's Investment Advisory team, and I look forward to spending the next 1 hour with you. However, joining me is special guest speaker, Dr. Ben. He's the Assistant Professor of Finance at NUS, also the co-founder of Chicago Global, a quantitative investment firm here in Singapore. Right? He specializes in the application of natural language processing and machine learning for investments and credit risk analytics. Would you like to say hi, Ben?
Hi. Hi, everyone. Thank you very much for joining. It's a pleasure for me to be here.
And also joining me today is Syfe's own Head of Investment and Advisory, Ritesh. He leads overall development and evolution of our investment product suite across the region. And today's session is bound to be an exciting one, covering H1 market review, H2 market outlook, and the thematic sector artificial intelligence. So the key question on everybody's mind, is it hype or reality? And after which we will then move on into Q&A. And for myself, I'll be going through a little bit about us here at Syfe, just for the sake of the new joiners here. Right, so a little bit about us. We are a Singapore headquartered MAS and SFC licensed digital investment platform. We do believe that investing should be accessible to everyone. We enable people through smart, affordable, and intuitive financial solutions. Right, so we do aim to be an all-in-one destination to grow and manage wealth. You should be able to find us on wealth and trade, right? Wealth offers managed portfolio services, and trade is our brokerage platform, giving you access to ETFs, stocks from both the Singaporean and American market. And you are also able to do fractional shares investing and automated recurring buys. So we have more than 100,000 users here in Singapore. And of course, we aim to actually have more users on our platform through innovative investment tools and strategies and access to the latest insights, which allows us to support users in acting for their financial future. So a little bit about our journey. We started back in 2019, July, and we actually went through 2 rounds of funding, 2020 and 2021, and followed by the launch of our brokerage offering, Syfe Trade, in 2022 Jan. Right. We then launched Syfe in Hong Kong in May 2022, and then followed by winning Wealth Management of the Year award in August of 2022. We then launched Syfe in Australia, same month in August, followed by the launch of Income Plus, which is our first collaboration with a fund manager, PIMCO, in April 2023 of this year. Right, so safety is our #1 priority. We do meet the stringent requirements by MAS for our CMS license, the Capital Market Service license, right? We are an exam license holder, and funds are always held in a trust account, right? So for cash, you should notice that your deposits go into a DBS or HSBC account, and once it's actually invested, it's actually custodized under Citibank and HSBC. Right, so some poll questions before we begin and before I hand it over to Ritesh. Can we have the polls here? Right, so let's see. How do you think the stock market has performed so far this year? Right, looks like most of us believe that it is better than usual. And what do you think about these results, Ritesh? Oh, I believe you're on mute, actually.
Hey, hi, Melvin. Yes, so looks very interesting. And pretty much, I think a lot of people have seen how the markets behave. So it's good to see that there's a good amount of people who understand what's going on the one market. Sorry, I think there is an echo. Oh, sorry, I'm not able to hear you properly. Continue, yeah, Melvin.
So this is question 2 of our poll. Sorry, are you able to see the poll? Right, so this is question 2 of our poll. What do you expect the overall stock market performance to be in the second half of the year? Now, before I show off the results for this question, what's your thoughts on this, Ben? Oh, having a sip of water.
Yeah, I think it's interesting. It seems most people understood that this year has actually been pretty good, even though it seems, people don't really feel like it. So we see some of the results coming in now, and it looks at least broadly consistent, right? What happened first half of this year, it seems we think will continue for the second half, with the modal response being we think it's bullish, and so I guess a lot of people here are increasing their equity allocations.
Great. Now let's move to the third question. Right. So, which of the following themes excite you most?
Is this an example of what they call a rigged question with the topic of the webinar today?
No, but I believe it is the topic that's on everybody's mind, given the astronomical pinnacle of where AI stocks are at today. Right, so let's take a look at the results, although it shouldn't be any surprise. It is, in fact, artificial intelligence, but surprisingly, looks like fixed income is in a close second, followed by China, then cryptocurrencies. Does this mean that cryptocurrencies is going to take a step back from now on? What do you think, Ritesh? Don't think it's able to hear me. It's okay. Let's move into the next slide.
Thanks so much for the good introductions. Pleasure to be here and very excited to do this session today. Apologies for the tardiness earlier. I think my voice was echoing to itself, so apologies on that. But let's start this particular session. Very excited to cover what has happened to the markets for the first half of the year, as well as what do we expect for the markets going forward. Let's start the session with a little bit of a review of the financial markets for the first half of 2023. Before we do that, let's just look at some of the things that are top on mind for every investor's mind. Obviously, there has been a great rally starting off 2023, but it's been an uneven rally, and we'll dig in a little bit deeper into what that uneven means. In terms of macro, indicators, people are looking still at inflation numbers. They are, waiting for the Fed policy, and there are lingering concerns that are still remaining in terms of recession and when will it happen, or whether there'll be a soft landing or a hard landing. We will want to cover a little bit about what our outlook is for 2023, as well as our special section on AI and the future of investing. So starting off 2023, we are obviously coming from 2022, which was pretty brutal when it came to stock market performance, because the S&P 500 for the full year of 2022 was down 18%, and NASDAQ, which is the growth index, was down more than 30%. On top of that, investors actually found it really hard to diversify their investments in 2022, because even bonds, which are supposed to be your protection asset, fell in tandem with the equity markets. Inflation reached multi-decade high, and which led the Fed to do its fastest rate hiking cycle since the 1980s. Now, obviously, coming into 2023, the prospects of the market actually looked bleak. However, even though we faced significant challenges throughout the first half of 2023, in the form of, say, the banking stress that unfolded in February, March, the rising risks of recession, and the continued tighter monetary policy, you see that the equity markets has actually defied expectations and notched up double-digit returns for the first half of 2023. As you can see from this chart, the Nasdaq in the technology sector has led the rally for the year. The US stocks have also outperformed compared to the global stocks, and the S&P rallied close to 16% compared to MSCI World, which rallied 14%. One of the notable outliers within this was obviously China, with the benchmark index giving up almost all of its returns and turning negative, with expectations that were set for a post sort of reopening surge were quickly dwarfed with persistent concerns and worries about growth as well as geopolitics. If we go to the next slide and take a closer look at the rally this year, it is very interesting to note that a handful of these mega cap technology stocks with exposure to AI have driven almost all of the growth for S&P 500. They have made an outsized impact on the returns as they account for a significant part of the index as well. Now, obviously, interest in AI has surged this year since the launch of ChatGPT, and this has generated a lot of excitement and frenzy among investors looking for new growth drivers to the economy. And why has there been so much optimism? It is mainly centered around AI's role in terms of boosting productivity and its transformational impact across a wide range of industries. We'll talk a lot more about AI in our special segment with Ben, so please hold on as we uncover whether this is hype or reality. But you can see the difference between the 7 key stocks that led the whole rally versus all the other components of the S&P 500. The returns would have been pretty flat. Now, if we drill down a little bit further in this particular chart, we see the sector drill down, right? And we see that there is obviously also a significant dispersion in returns across different sectors. Technology-related stocks across, say, IT, telecom services, and consumer discretionary, they have mostly driven the year-to-date performance. And defensive sectors such as utilities, healthcare, and consumer staples have turned, in fact, red. Now, financials actually started the year quite well, but with the rising interest rate environment, they were supposed to do well. But the regional banking crisis in the US actually spread through the entire financial sector and had led the share price to not have too much growth through the first half of 2023. Now, also the energy sector was driven lower as oil prices dropped from the highs of $130 a barrel last year to $75 this month. Let's go on to the next slide, which covers inflation. And I guess I think before inflation, there is the slide about, the returns, which have obviously come from the fixed income side of the world as well. And as you can see, the high yield sector of the fixed income has led the performance. Yields are also at multi-year highs compared to where they have been a couple of years back. Yields from fixed income was, close to zero or very, low single-digit returns. Now, coming into 2023, the year-to-date returns have been dominated by high yield. They have done well, even though they were much more volatile through the first half of the year compared to the more intermediate as well as the more investment-grade components of the fixed income space. We will talk a lot more about fixed income in the outlook part of the section. But before that, let's talk a little bit about inflation and what's been happening there. As you can see from the chart on the left-hand side on the top, the headline inflation has actually peaked for most of the regions, and it is now firmly on a downward trajectory in the US, Europe, and many other markets. Now, this is mainly due to lower energy prices. As I was covering earlier, the energy prices have moved down from $130 a barrel to now $75 a barrel. Supply chain disruptions that were there have been mediated as well. And then a series of interest rate hikes by the central banks have also led to a moderation in the overall inflation levels. In terms of the US, more specifically, it has actually led most of the inflation rates lower, as the CPI grew by only 3% per annum in June, down from 4% a month earlier, and it marked the smallest rise since 2021. Even on the core inflation side, which basically means excluding food and energy, However, it has proved to be a little bit more stickier, but it has also begun to turn lower. And again, in the last print, you can see that the core inflation rate is 4.8%, again, one of the lowest rates since 2021. Now, what is much more interesting in the chart is, if you look at the right side, it actually captures what are the main drivers for inflation. You can see that the shelter subindex, or, basically representing rent and utility payments, it was actually the main driver for inflation in the July print, or the June print, sorry. And it accounted for more than 70% of the overall CPI increase. So excluding shelter, if you just excluded that part, the CPI would have come up with a 0.7% increase, right? So most of the inflation driver right now is actually not due to energy and food, but more driven through shelter and related categories. So now I think when it comes to a view in terms of going forward, what do we expect core inflation? Where does it go going forward? There are a few factors why we believe that there is a disinflation that is already kicking in, and we can expect inflation to continue to trend lower. And the points are basically, number one, energy prices, right? So they continue to cool while there are now some supply controls being put in place. But overall, the energy prices have become much more stable. Shelter inflation, as I talked to you earlier, also is expected to continue declining. Now, market analysis actually says that at least half of the post-COVID premium on new rentals that was there is actually unwound. So we should continue to see rental prices coming down as we move forward. There is also a significant progress on the labor market front, and the sequential growth in the hourly earnings has also slowed to 4%. So all of these factors combined gives us a view that going forward, if you look at the key drivers of inflation, and if shelter can be controlled a little bit better, we can expect that the future pace of inflation will continue to trend lower. So while we are not going to have a deflation, but there will be continued disinflation as we move forward. And that actually brings us to the point of how will the Fed behave in that particular circumstance. And the Fed on its side has continued to hike its benchmark rate by more than 500 basis points since March 2022. And last month, the Federal Reserve actually, for the first time, skipped a rate hike. Now, the next meeting for the Fed is as soon as next week, and there is a wide expectation that the Federal Reserve will raise the interest rates by another 25 basis points, with the benchmark rate then going into the 5.25 to 5.5% range. Now, given, again, our view on inflation, which will continue to moderate quickly than what the Fed is kind of currently projecting, we actually believe that this might be the last rate hike in the current cycle, even though the current 2023 dot plot actually suggests otherwise. However, in terms of a rate cut, I think that gets pushed a little bit further away. So while the Fed will potentially stop the rate hikes after the July period, we believe that the rate cuts that the markets are pricing towards the end of this year might not happen this year, but will happen close to early next year when the Fed sees more data points and sees inflation meaningfully trending towards the 2% target rate. Moving on to the next slide, talking a little bit about recession, because this is something that everyone is worried about. Now, again, with easing inflation, a labor market that continues to remain very, very strong, and the overall economic resilience that we have seen in the market actually makes us much more optimistic about the economic outlook. If you look at the chart on the left, it actually represents the poll that was conducted by the Wall Street Journal, and it measures the probability of recession. And if you see, the probability of recession had again peaked to around the 61-62% mark, and the latest poll suggests that the probability of recession by the economists is now at a 54% level. Now, again, this probability is still very high, but I guess the drop that you see is the largest month-over-month drop since the August of 2020. So what does that mean? We believe actually there is a reasonable case for the Federal Reserve to achieve a soft landing or get to control inflation without causing a recession. And this is back on the table. There are a few reasons why we believe this can happen. The US economy overall in terms of activity remains fairly resilient. The Q2 GDP print came out at 2.3%. The consumer sentiment remained, pretty sharp. After, some depressed levels, it has rebounded quite significantly. Unemployment has fallen back to 3.5% in June. And the initial jobless claims, again, look pretty solid. In terms of inflationary pressures, as we discussed earlier, they are easing. And there are strong reasons why we can expect continued disinflation. In terms of yield curve, usually, seen as a sign that if the yield curve inverts, then there is a recession that should happen within the next 12 months. We believe, again, with the Fed potentially stopping the next rate hike or stopping after the next rate hike in July, the pessimism that is baked into the yield curve will also likely ease. And all of these factors together means that while we might have a recession, it might not be the hard landing that people were anticipating previously. All right. So having covered that, let's look at the market from a going forward perspective, right? We will first look at the asset classes, the different asset classes in the market and their forecasts going forward. Now, in terms of all the asset classes, one thing is clear. The future looks much, much brighter across these asset classes. If you look at both these charts on the equity and the fixed income side, it kind of compares what are the expected returns of these different asset classes from 2021 to now. And you can see a meaningful shift to the right in terms of these expected returns and across different subsegments and all as well. Now, again, in terms of investors themselves, through the first half of 2023, they have actually fled to cash as interest rates had soared over the last 1 year. However, coming into the second half of the year, actually the long-term capital market returns show a much more appealing investment environment. And if you look at these charts across the fixed income and equity space, the equity or the expected returns over the next 10 years look very, very attractive. Now, particularly on the equity side, if you look at the more US portion of the market, it does look a little bit more rich in valuation. And that's why the expected returns are, still low single digits. But there is growing optimism in the non-US equity space, which should probably be propelled higher by a combination of higher dividend yields as well as multiple expansions. On the fixed income side, the US fixed income should improve as they, number one, start from a much higher yield point. And number two, they also benefit from price appreciation and declining yields as we move towards 2024. And so from a total return perspective, if you look at the fixed income market, it looks very attractive, both the US market and particularly if you look at the emerging market, it looks even more attractive from a total return standpoint. Moving on, if we drill down a little bit further within the fixed income world, we actually believe that the fixed income space today provides very compelling opportunities for investors. Current yields are at some of their highest levels across different subsectors within the fixed income space, meaning that fixed income market now offers meaningful income. They also offer yield protection and attractive in terms of valuations. Also, I guess when you look at this particular chart, you do not really need to take too much risk when it comes to taking exposure to fixed income, because even investment grade is giving you north of 5.5% yields, which was previously just not the case. So right now, when it compared from a risk reward standpoint, compared to the equity market, you're able to generate much higher returns, probably in the mid-single, high single-digit returns, and without taking equity kind of risks. So that is, I think, very compelling in terms of building of your own portfolios. This can be used for you to achieve a nominal rate of return without taking, too much risk to begin with. Moving on, I guess China has been a story where, obviously the second quarter GDP print was quite disappointing. It came in at 6.3%, which represented 0.8% quarter over quarter, rise in the GDP number. But overall, it was much, much slower in terms of, expectations. The market expected a 7.3% rise and a 2.2%, quarter over quarter growth. So both of those things didn't really pan out for the Chinese market in terms of the GDP print. Also, actually, more alarmingly, if you look at the unemployment rate that came out from China, that also between the age of 16 and 24 was at a 21% rate, which is a new record. Now, again, I think while the quarterly numbers in China do not look that great, and some of these, other data points that are coming in also show a much more muted, viewpoint of China going forward. But I guess as we move forward, there is a growing case of China rebounding as some of these negative factors fade away in the Q3 and the policy factors continue to ease. So we actually maintain a pretty robust view on China as an attractive opportunity for equity investors. It has a pro-growth policy. The regulatory backdrop is much more supportive in the current scenario. And as you can see from the chart as well, the valuations of the Chinese equity market across the different sectors look very, very attractive, and they remain very depressed in terms of where they historically are. So in terms of, again, upside opportunities, if you're looking to take a more tactical view of the market, I guess China does present very attractive entry points. Last but not the least, I guess we just want to focus a little bit more on what happens when Fed actually stops its rate hiking cycle. We can go back in history and actually map out how the equity markets behave 6 months, 12 months, 1 year, 3 year, 5 year after a rate hiking cycle has fully completed. Now, if you look at the markets right now, obviously the S&P 500 up more than 15% on the year, and actually it's in a bull run coming up to be close to 25% above, the most recent low that was in October of 2022. The index also trades at a pretty rich valuation, trading at around the 25 PE multiple, which has been a much higher number compared to the historical average of around 16. And most of the investment houses are actually predicting that the forward-looking returns of S&P 500 might be much more muted, probably around the 0 to negative 5% range over the next 12 months. However, if you look at history, the history suggests that the index actually could keep on surging as we move forward, and especially when the Fed puts a hold on its rate hiking cycle. What has happened in the previous instances is the equity markets have continued to chug along positively. So if you look at the chart over here, the S&P 500 has actually gained 16.7% on average in the 12 months following the last 6 conclusions of a Fed tightening cycle, and which has significantly outperformed the historical average return of S&P 500, which is around the 12% mark. Even on a 3-year forward basis and a 5-year forward basis, you can see that the average return of the equity markets can be as high as 46% after the conclusion of, its rate hiking cycle, as is evident from the average over the last 6 such cases. At this point, I will take a pause to see if there are any questions or any comments from you as well, Ben.
Yeah, I think you raise a very good point on the yield curve inversion. So at NUS, I teach international financial management, right? We think once the yield curve inverts, a recession is coming in about 12 months. But what people tend to miss actually is after the yield curve inverts, on average, the market still rises by over 20% before the recession comes, right? So certainly things seem to be coming with a lag, and that's fairly consistent with the data that Ritesh showed. So Ritesh, I'll hand back over to you to summarize the outlook.
Hello. Hey guys. Sorry, I think I lost the last bit again. Ben, can you hear me?
Yeah, I can hear you. Can you hear me?
Yeah.
Yes, all good.
Well.
Cool. So let me just quickly summarize the state of the markets as well as the outlook, right? So if you see, as we covered earlier, the state of the markets in terms of the equities, it's really been a domination of the mega caps, right? With the Magnificent Seven kind of leading the rally. The key sector leaders have been the tech, telecom, and the consumer discretionary. On the fixed income side, also positive for the first half of 2023, with the US high yield kind of correlated with the equity markets chugging along pretty well and outperforming the investment grade in the sovereign space. In terms of the macro, overall, we are looking at a disinflationary environment as we move forward. We are seeing a peaking of rates and potentially one of the last rate hikes that the Fed will embark upon in the July meeting next week. And also from a recession worry standpoint, you can see that the recession probabilities have continued to move down as we see from the Wall Street Journal economist poll as well. And in terms of the outlook going forward, we see actually a much brighter future across asset classes. We see equity-like returns from fixed income, so much higher single-digit returns, but probably at the half of the volatility that you see in the equity market. China, yes, the data points continue to be disappointing, but in terms of valuations, they continue to look very, very attractive. And last but not the least, usually whenever the Fed stops its rate hiking cycle, it has actually led the equity markets to continue its rally forward. So hopefully, if history were to suggest what it is suggesting, we can see the equity markets to continue its positivity going forward too. With that, I will hand it over to Ben. Ben, over to your section. I think most of the people are looking forward to hearing and learning more about AI.
Great. Thank you very much, Ritesh. I'm assuming people can hear. Before we get started, let's go through another poll. How do you feel about AI-powered robo-advisors for your investments? It's a very interesting question, almost as if this is like a market research question. And I'm hoping most of you have played a little bit with ChatGPT and the likes of that as well. Okay, so it seems most people are somewhat comfortable. I guess that's part of revealed preference because, as I'll explain, what Syfe does also is data-driven, and therefore you can call some of what they do, quote, quote, AI. And I'll describe a little bit what we mean by AI versus machine learning and other stuff. There's also a theory of financial advice where the theory says people like people, right? There's something about you going to a doctor to tell them about your problems, and you're happier that it's a human listening to you as opposed to a machine, even if the machine may be even more predictive and their forecasts are more accurate. Okay, so let's spend some time now talking a little bit more about what AI is. So if we go to the next slide, I'll just give a brief background on artificial intelligence. And here at NUS, I supervise PhD students in the Asian Institute of Digital Finance. For most of the faculty here in NUS Business School, in the finance department, being able to do some form of machine learning has already been like a requirement for years. Okay, so it's to us, it's not really mind-blowing stuff. The foundations for AI were laid in the 1950s. And I want to draw your attention to two interesting developments that were happening pretty much simultaneously. On the one hand, we have Alan Turing. So if you don't know who that is, you can watch the movie Imitation Game by Benedict Cucumber, right? Benedict Cumberbatch, okay, he portrays Alan Turing extremely well in that movie. In 1950, Alan Turing actually came up with something called the Turing test. Okay, and at that time, as computation was being developed, the theory of computation first came out because computers were actually really weak. Okay, so when you can't do computation, you write the theory about it first. And then the idea has always been the be-all, end-all for computation is what we now call artificial general intelligence. That is a machine that is able to think and reason like humans. And of course, we've had a lot of sci-fi, right, built on top of this idea. Simultaneously, okay, across the Atlantic Ocean in the United States, data-driven investing was introduced. It was introduced by a guy called Harry Markowitz in his dissertation his PhD dissertation at the University of Chicago in 1952. And that actually applied engineering optimization tools to portfolio management. And it revolutionized the way we view investment management, because before that, it was all about stock picking, right? How do I find the best stock? Which company is good? Back then, we didn't even know how to measure returns. So we like to think of dividends as returns without focusing on the capital gains component, right? As most of us know now, right? For example, in the S&P 500, dividend yield is only about 2%, right? And the vast majority of the returns is coming from capital gains, okay? And so the development of the toolkit was simply to take the stance that instead of picking what is a good stock, you can treat them as bets. They're all bets, right? They have some statistical property. Therefore, we can use statistical tools to help solve this constrained optimization problem. But interestingly, as both of this was developed, the theory of computation on one hand, as well as data-driven investing on the other hand, over the next couple of decades, things actually slowed down. And a big problem with that development was actually that we didn't have enough data. Okay, we had models, people developed neural networks. So even the models that are being used today, so BERT, some of these things are built atop of this idea of neural networks. They were developed in the 1970s, right? And back then it was viewed as almost like a dirty science because sometimes things would work and people don't really know why, right? It's this introduction of a black box. And even back then, statisticians were not a big fan of a black box, okay? But things have really changed dramatically with the invention of the internet, right? And the internet effectively supercharges the data creation, right? And I'll show you a slide. In a couple slides, we'll go through how much data is actually created in a day. And that has given birth to this new resurgence, right, of AI, where now you can have those models train on much richer data. And in fact, with better computational hardware now, we can then scale those models up tremendously, right? And that manifested itself with GPT-1, okay, which sucks, right? And now we're at GPT-4, right, which is very good. Okay, so this development has been exponential, and we think it's going to only speed up as the innovation keeps coming. Okay, so the recent advances in this thing called a transformer model switches the way that we do some of the computation, right? And it's now given birth to this explosion or this hype, okay, of what's going on in AI. So if we take a look at adoption of technology on the next slide, we actually see that, for example, Uber, right, which is the father of Grab, right, what inspired Grab, it took 70 months to have 100 million users, right? Spotify, 55 months, Instagram, 30 months, TikTok, 9 months. And if you look at ChatGPT, it only took 2 months to hit 100 million users, right? And so if you haven't tried it, I highly encourage you to play around with it a little bit. Try not so much to ask that many knowledge questions, okay, because it does hallucinate once in a while if you ask it for too many facts, especially very detailed facts, right? But in terms of being able to communicate and contain ideas and have some kind of logical flow, right, it actually seems like a very impressive tool, right? And I'll explain later what makes this stuff AI is this notion that it seems human, right? And that it can communicate with us, that being the key. If all the machine learning simply results in a SQL database that you need to know how to do programming to understand and read, right? There's still a hurdle there, right? So the big innovation is actually taking some of that analytical power and delivering it to you, the end user, in a way that's much more easily digestible. Okay. And if we look on the right in the United States, if we look at the mentions of AI, okay, right, you actually see this explosion of analysts and CEOs talking about AI in their earnings call, right? So it seems they are responding to this new innovation. If you look at Jensen Huang, the CEO of NVIDIA, pretty much his entire speech was about how NVIDIA is going to be the core of the AI revolution, right? And so there's going to be a gold rush, and NVIDIA is selling the pickaxe, right, for people to go and mine that stuff. So that's the pitch. Okay, I'm not saying we should invest in NVIDIA. It has done quite well, but we'll talk a little bit later on about how to navigate the investment space. So if we go to the next slide, we can focus on the one hand, ask ourselves, what's AI doing for us, right? And obviously, the clearest thing is, what stocks should I buy, right? We have Syfe Trade. I assume you can trade some stuff for free, right? A lot of exciting stocks. I can buy 0.1 shares of Tesla, right, if I really wanted to, right? And so we have a lot of news about, okay, what are the AI stocks? And there's some analysis there. Everyone wants to get in on this. And remember, newspapers are still a business, okay? So their job is to sell subscriptions. And so they want to write this and get you to read their material as well, right? And so we have some that are talking about the AI, the hype, and the others is talking about the AIs being maybe a little less than what it promised, right? So more hype than bite, okay? So there's always a mix between them. This is one way to view AI, right? And there are plenty of resources online if you're interested to look at that. But if you notice, a lot of those suggested stocks seem to forget the old economy, right? They actually treat the old economy as like something that we forget about. But it turns out Walmart has been experimenting with AI for a long time. If you study in the business school and you take an operations management class, you'll realize a big part of why Walmart was successful was its logistical platform, right? And now they can adopt the use of AI to actually improve their efficiency even further. We expect a lot of old economy companies to also benefit from AI. But as Ritesh showed, the S&P X, the Magnificent Seven, is only up like 4%, right? And so really the impact of AI in business processes and productivity improvement hasn't quite manifested itself yet in the stock market, right? It's only been concentrated among like the 7 biggest winners of the AI boom. That's one way to think about it. Another way, and I'll try to give you this as a food for thought, is incorporating AI into how you actually invest. Okay, so in the next slide, we'll talk a bit about how much data is being generated. Okay, so now we think by 2025, estimates say we're going to generate, 463 exabytes. Okay, I don't even know how many exabytes are. I know it can't fit on my laptop. Okay. We have 500 million tweets a day. Maybe 100 million of them is by Elon Musk. Right, we have billions of emails a day, billions of web searches, terabytes and terabytes of digital footprint data. It seems like we should be able to use AI somehow, right, to actually improve our investment decisions, right? So you can say, all right, let's AI this thing. Okay, now what does that mean? Right. So in the next slide, let me describe to you what does that process actually entail. So the chart on the left is a little hard to read. It comes from a research paper that's actually outlining a quantitative investment process. Okay. Each little box is a little submodule that feeds into the system. And I'm showing you this not because I want to spend 2 hours going through it, but I want to show you that when we say, let's AI this thing, okay, it's actually very complex. Using AI to find profitable investment strategies is tough. That's what we do at Chicago Global. Okay, we've spent over a decade honing that skill, and we've been deploying the models for 5 years. Before ChatGPT came, people thought we're a black box. Why should we do quant? And now with the boom of GPT, we've had now many more investors come ask us about how to access the market. Now, the challenge is, it requires a lot of skills. You need to know programming, you need to know stocks, right? If at the end of the day you want to use AI, but you can only think of like the same 10 stocks that everyone is thinking about, there's very little edge that you will have, right? Because remember, the market is an adaptive system. It's not so much about whether you can find good companies. It's about, can you find something better than the market, better than everyone else? Can I find a company that's undervalued? Can I avoid companies which I think are overvalued? And to do that, you require a fair amount of understanding of the financial markets. You need high quality data feeds, right? So if you look at Elon Musk's tweets and try to trade the stock market from that, probably you're not going to make very much profit, because most of his tweets is garbage, right? He's tweeting about random stuff, culture war, right? Making fun of Mark Zuckerberg, right? So it doesn't seem that informative for investment decisions, right? So you need to actually build a model to pull the information out, right? In some sense, it is really about finding the needle in the haystack, right? And so if someone asks you, how do you find the needle in a haystack? Well, the answer is you use a magnet, right? And so the magnet here is learning to actually deploy that information system. Okay. And it's worth remembering that when you're thinking to invest in the market and trying to maybe bet on the AI cycle, the low signal to noise ratio of the market is actually a feature, right? It's the fact that markets tend to be efficient, right? Not always, but it tends to be, right? Because if it's not, I can make money by trading it. And that's not a bug, that's a feature of the market, right? And so by definition, this should be hard. So if you're trading and you think it's very easy, that's a red light. That should be a flag in your mind that maybe, you know, what you believe is not quite right, right? Or if you believe something that every one of your friends believes, maybe there's not much room for opportunity there, because everyone's doing the same thing. At the end of the day, I would want to just remind that investment returns, okay, that's the only equation in this slide deck. Okay, and your investment return on the portfolio is a function of both the investment strategy, that's the stuff that you invest in and the different securities, and probably more importantly, your behavior. That is, when times are tough, can you stick in through the market? Right? Everyone wants to take more risks when it's doing well, and they want to cut risks when it's doing poorly. Turns out predicting that stuff is very difficult. Right? So how can you design some system that actually helps you weather the storm? So that takes me to the last point I would like to make on this AI component, this thing of personalized investments, right? So we ran this poll about using some machine learning or AI, some kind of data-driven model to help you actually invest better, incorporating your risk tolerance, which may be multidimensional, not just volatility. You might have cash considerations. You might have savings goals, cash flow goals, different financial plans. We all have potentially different personalities, right? I just like different types of investments than you do. And so we should be guided into a different set of investments. Or we might have different beliefs. You might think one sector will do well versus another. How can you incorporate that view into your portfolio? And so I'm citing a research done by faculty members at MIT that if we just move from a basic rule of thumb to say, look, if you're this age and this much income, here's your equity. If you switch it to a more personalized model that accounts for more of your personalities as well as risk tolerance in a rich way, you can actually increase your lifetime consumption by 2 to 3%. The question is, how much is that? 2 to 3% over an entire lifetime, okay, is like, are you eating at the hawker center versus going to a restaurant? Okay, so that kind of helps you put things in perspective in your consumption bundle. And it's unsurprisingly, although the average, by definition is the average, most people are not the average. In fact, maybe nobody is the average, all right? And so we might think about how can we use AI to actually improve recommendations and news flow of what you're actually seeing on your trading platform, right? And that's going to be work in development that I understand Syfe is also working on. And lastly, financial education. You can use ChatGPT to actually run some ideas like, should I be doing this? What if this is my mortgage? What if this is my CPF? Does this seem like a reasonable thing? It can pull some standard templates to actually help guide you, right? And it can do it very fast. Okay, I'll close out with this last slide looking at different cycles. Okay, we've had COVID winners coming in a couple of years ago. That was replaced quickly by GameStop, right? AMC. And then it was replaced by oil and gas. And now oil and gas is coming down, as Ritesh said, and AI is taking off. So the question is there something deeply different about the AI cycle? And is it already being picked up in the market? Right. So it seems at least the top 7 stocks seem to have captured some of that benefit, but there's still, S&P 500, right? There's still 493 stocks, right? That doesn't seem to have fully internalized this in its prices yet. So I'll close out with like almost a joke in the end. So, it won't be complete without using AI itself. So Melvin will go to my last slide. You can ask ChatGPT, will you replace investment managers? Okay, and it answers in a very politically correct way, right? No capability to replace investment managers or human professions. The job is to assist and augment human capabilities, not replace them. So how can AI help us be better humans rather than exploit our mistakes? So with this, I'll just close out and hand it back over to Melvin. Thank you very much.
Thank you so much, Ben. So we'll now move on to the Q&A. So there should be enough time for us to squeeze out 2 questions, one for you, Ben, and one for you, Ritesh. So maybe let's start with Ritesh. We'll give Ben a chance to drink some water.
Sure.
So Ritesh, so one question for you will be, how close is Syfe in implementing some form of artificial intelligence in the way that we manage our investments, given that you do lead the innovation and the evolution of investment products here at Syfe?
Hey, Melvin, great question. And, thank you for asking. This is something that we have been exploring pretty deeply within our ecosystem as to how we can leverage and use AI to complement the users in terms of making better investment decisions. I think some of the stuff that Ben covered as well reflected a lot of things that we are working on as well. When it comes to investment preferences, when it comes to investor behavior, sentiment, all of those are, as Ben covered, very unique to each and every personality and each and every person. And this is an area where we can really go further down and explore how we can map out in a more contextually relevant manner what kind of investments is suitable for a particular person. And so this is potentially going to be one area where we'll be digging in much deeper. Building in features such as the ChatGPT kind of a framework is a pretty straightforward process. Now, these kind of stuff is kind of available in plugin formats. So we can very easily plug these kind of aspects within our ecosystem and make it very conversational for our users to understand our platform better and analyze their portfolios. So I think what will happen is, as we move forward, the advent of AI will enable us to provide much deeper insights. So it will start with insights on our client portfolios, their behaviors. It will also give us a lot of data points to then be able to recommend and suggest things in a much more contextually personalized manner as well in front of clients. I think the last part is having AI generated investments, right? So this is an area where we believe we want to be much more responsible and, a little bit more research oriented in terms of how we develop those kind of capabilities. And this is still a very much, area which is nuanced. So Ben probably has a much more deeper, play in that. And we hope we can collaborate in some form to enable such investments for our clients in the future as well.
Great. Thank you so much for the great answer. So maybe one question for Ben. So just now, I think Ritesh touched on responsible, and you previously mentioned something about Elon Musk as well. So Elon Musk is known to be like a pro-regulation and controls over AI. But what are some of your thoughts on that? Do you think it's good for AI? Do you think it's necessary? Or do you think it's just, one of his many cry for attention?
That's tough. To enter the mind of the great Elon Musk. I'd say this. So I think we haven't quite felt the impact of AI yet. Again, I think the market has totally underreacted in terms of how AI is going to affect the broader economy and the ecosystem. I think people have focused very much on just a handful of stocks. I don't think that's representative of what will happen. So, for example, Nisha has a question also, right? What kind of other industries should we look at? And I'll bring it back to like who can use AI, right? So it actually, AI is a type of intangible capital, right? It actually scales with firm size. So the more complex your company is, the bigger you are, the bigger the marginal gains of AI. If you think about it, the AI is not going to benefit so much a company with a lot of customer service representatives in America, but it might help a lot a company with a lot of customer service representatives in the Philippines, right? So now the AI can help people in the Philippines communicate, more correctly, more timely, right, to address some problems. So I'd say like I'd focus more on kind of old economy, big companies that could benefit from an information transformation. Companies that haven't quite made the leap, I would say those are very undervalued now. And so if they can deploy this new technology, I think they can scale it easily. In terms of where the AI will go, right, I think we need to just make peace that the next time you get a phone call from your mother, right, it might sound like your mother, right, but you need to like ask them your secret code, right, and you keep updating the code every day, right, because of deepfakes, right? This webinar is being reported. So Melvin, Ben, and Ritesh are already in the system, right? So there can be deepfakes of us popping up all over the place, right? Saying all kinds of things. I think this dark side of AI is coming. And I do think some of the technologists are right to try to put on some guardrails, but I also think the revolution is too explosive to try to contain. Kind of like crypto, right? We saw that explode and then that crashed spectacularly. It seems to me like AI might follow something similar, or we might get ourselves into some trouble. And then we'll try to have to dig ourselves out of it.
Perfect. Thank you so much for that great answer. So maybe one more question for Ritesh, but before you answer, I just want to share what's on the screen right now. So we do have our 4th birthday anniversary promotion on screen. So those who are keen to get started on wealth or trade, do use the promotional code there on screen on the right-hand side. Yeah, but one last question for Ritesh, right? Is a soft landing in the US economy a base case now? If this is the case, does it mean that the stock market has already bottomed last year?
Great question again. So this is something that we covered earlier on during the market outlook piece as well. I think the key drivers of whether there will be a recession and how deep that recession will be, again, comes down to the Fed policy as we move forward. And if you were to look at how the Fed has been, utilizing data to determine the hike or the pace of rate hikes and all, it's been pretty adamant in terms of making sure that the rates remain pretty high until there is meaningful signs of inflation. Now, however, going forward, if you think about these data points, the signs of core inflation coming down has started to come up quite, prominently. And this is something that I think the Fed will obviously take into account as it moves forward. And in terms of, the core inflation itself, as I covered earlier, while there are some components of the core inflation which are still remaining a bit more sticky, but as we look at shelter inflation and food and prices and other such categories, which are now the major drivers of the inflation going forward, and the older, parts, which were the energy and everything, those have softened quite a bit. As we move forward, these elements will continue to soften as well. And we believe that the pace of inflation will come down at a faster pace than what the Fed is currently anticipating. And that basically means that even though the Fed's own dot plot right now suggests that there are 2 rate hikes coming, one in July, another one later, the actual path might be just the 1 rate hike coming in July. And though I guess the rate cuts might happen early on in 2024 and not this year, but at least that will make the markets a little bit more positive as we move forward, and which can actually mean that the US economy can achieve a softer landing compared to what the broader consensus is right now.
Thank you so much for the answer. So I believe this is all the time that we have for today. Thank you so much, Ben, for for joining us and delivering such a good presentation and answering those questions. We do hope to see you again here. And is there any final statements that you might want to make before we go?
Well, so since we've advertised for Syfe, we can advertise for NUS as well. Okay, so we have the Asia Institute of Digital Finance. If you want to get your hands dirty, actually deploying live models, please feel free to apply. You can find me on the NUS website if anyone's interested to connect and discuss more. But it's been a real pleasure. Thank you for moderating, Melvin. Thank you, Ritesh, for the very detailed and data-driven discussion on the outlook today. It's been a real pleasure, gentlemen.
Thanks, Ben. It's been a pleasure as well, and look forward to having you again.
All right. Have a good night, everybody. Thank you.